Oliver, today Aberdeen Asset Management announced that they're doing a £100 million issuance of preference shares. It's not a lot of money for a company with $5.5 billion in market cap. Why are they doing this?
Well, it's a good question. What are they doing? It seems innocuous enough. A share issue to raise £100 million, and the buyer is Mitsubishi Financial, who's already the biggest shareholder, and it seems like a fairly small deal, as you say, in the context of the group. But remember, at the same time, Aberdeen a few weeks ago has announced a share buyback programme of £100 million, coincidentally. So what they're doing is they're buying back £100 million of ordinary shares, but at the same time raising £100 million through the issuance of preference shares. The overall effect is to change some of their funding from ordinary shares to preference shares on a fairly small amount of their funding. It seems like a fairly odd thing for them to be doing.
So why do they say they're doing it?
Well, they're saying that this fresh money they're raising, the £100 million preference share issue, will be used to seed new funds. Aberdeen has been diversifying lately, and it was known as an emerging market specialist, but it's been diversifying. It wants to create new funds, but to do that, it needs to put some of its own capital in there just to get things going. And this money, it says, will be used for that. Now, you might well ask why do that through the issue of preference shares rather than just use the money that they had earmarked for buying back ordinary shares? And that's a very good question. Partly it might be slightly cheaper for them. The preference shares pay a fixed coupon of 5%. That's about £5 million a year, and that's fixed. The dividend on that amount of ordinary shares will be over the next few years will rise slightly above £5 million. So it is slightly cheaper to fund this seed these new funds with preference shares rather than using ordinary shares. So it does look slightly more efficient.
So is it a good idea then?
It just leaves a lot of questions open. The amount of money they will save through doing this is not a massive amount. By 2016, 2017, maybe it's £1 million a year, probably a little bit less. So it's not a huge amount of money they'll save. And you've also got a question, why did they only sell these to Mitsubishi Financial? Why didn't they offer everyone the chance to buy these things if they're such a great thing to own? The structure isn't exactly clear. Will the preference shares definitely have the right to get dividends before the ordinary shareholders are paid? That's often the case with preference shares, but it's not exactly clear in this case. And why just issue this £100 million of them? Why not go for a bigger amount? And finally, if they need this money to seed new funds, really, would it not have been easier just not to have bothered with the share buyback and to have used the capital they've already got? It seems very odd to be doing the two at the same time for a relatively small saving. So more questions than answers, I'd say.
Definitely. Thanks very much.